Hello and good morning again from London. We're here today for the second half of the Objective Capital Resource Investment Conference. Yesterday we heard some very interesting remarks concerning the notion of commodity super cycles. As investors, we are certainly well aware that we are in a commodity super cycle right now. What many people perhaps are not aware of is the fact that commodity supercycles have occurred in previous decades. Commodity supercycles, as we learned yesterday, typically tend to be driven by negative real interest rates, and what is also interesting is that during a commodity supercycle, it is very typical to see the equity markets in general experience declining behavior. So how do we know when a commodity supercycle is about to end? Well, two signs. Number one, the real interest rate scenario will turn positive. And here's the shocker. You will know that a commodity supercycle has about run its course when you see the equity markets trading at a PE multiple of approximately 5.5 or 6. Right at this time, as we finish the third quarter of 2011, we have the S&P 500 index with a PE ratio of approximately 11. The scary part is, if we are to get to a PE ratio of 5.5 or 6, that means we have a lot further to fall on the equity markets, but it also means we have approximately 5 more years left to run on this current commodity super cycle. Let's take a look now at a couple charts to put it in perspective. Now, I'm not going to attempt here to give a long diatribe on the subject matter of commodity supercycles. For that, I'm going to refer you to an economist called Chris Watling and his team at Longview Economics. Longview Economics is a British-based consultancy specializing in economic cycles and their analysis. Please be sure to take a look at their website, www.longvieweconomics.co.uk. You will be impressed with the subject matter you will find on their website. Now, this chart is exactly what Chris was impressing upon the audience at the Objective Capital Investment Conference. We have, in fact, seen commodity supercycles before, 1932 through till about 1951, 1968 through till about 1980, and in present day, we are living in a commodity supercycle right now, which began around about 2001. Now, what Chris emphasized was the fact that a typical commodity supercycle will last for around about 20 years. He also cautioned that any of these commodity supercycles will experience periods of time when commodity prices actually fall and investors run the risk of losing substantial amounts of money. These periodic declines in commodity prices within a cycle are often driven by political and economic events, and that's exactly what we are seeing play out before our very eyes in this current commodity super cycle. We have got a crisis of confidence coming out of Europe. Greece is on the precipice of a default. Various countries in Europe have seen their credit ratings cut by the rating agencies. There is fear now that China may be slowing down. There is fear that, in fact, the entire global economy could slow down, which could dampen the demand for commodities, and I think you get the picture. However, as Chris did emphasize, if you can navigate your way through these pullbacks within a cycle, you can do quite well. Now, in fact, if our current cycle did begin in 2001, and if these cycles do last on average 20-some years, we have got a fair number of years left to run. However, don't lose sight of what I said earlier. A typical commodity super cycle will also see the equity markets decline. We are currently looking at a PE ratio on the S&P 500 index of around 10.5 or 11. And as we progress through the remainder of this commodity supercycle, don't be surprised to see equity prices pull off substantially, and don't be surprised to see the PE ratio on the S&P index get down into some single-digit numbers. So again, please be sure to visit www.longvieweconomics.co.uk. You will be very impressed with what you see on that